Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Gabriel from Neuberger Berman to talk about what's happening in the private equity markets. Gabriel, it's great to see you again. Thanks for sitting down with Livewire today.
Thanks for having me, Chris. Always a pleasure to be here.
Of course. Last time we spoke in September, the thrust of the conversation was that you believe private equity was really well placed to navigate what might be coming for markets. We've seen a lot of change since then. What do you make of the current conditions and how's it impacting your opportunity set?
I would say in summary, we have been busier than ever, right? I think our deal flow has continued to be robust. So we do see a lot of opportunities in the private equity market, right? It's a function of two things. I think number one, just the extensive network of GP relationships that we've built over time. And second of all, I think we've been proactive in creating some of these opportunities for ourselves. And, as a recap, our private equity business really revolves around three main strategies, right? Primary fund investments, co-investments, as well as secondaries. On the primary side, we continue to back established GPs, right? So, re-upping to funds and also creating new relationships. At the same time, we've seen an interesting dynamic come through, right? Just given a tougher fundraising cycle, funds are taking longer to be raised. And as a result, we have the opportunity to step into a partially funded portfolio before the end of the final close. So that's good because it gives us a bit of visibility into the platform. So oftentimes, the fund might be about 20 to 30% invested, might be 4 to 5 portfolio companies. So that helps partially mitigate that blind pool risk. On the co-investment side, deal flow continues to be very robust, particularly in the co-underwrite space, as well as the midlife opportunities. And last but not least, on the secondaries front, as you know, it's been a busy year for the asset class, right? A good mix of both LP portfolio interests as well as GP-led continuation funds. So on the whole, I would say we've been keeping busy in spite of the market volatility, right? But I think the one thing that I would comment is that the bar is certainly a lot higher, and we're very cognizant of the general, uncertainties and geopolitical tensions that revolve. So the bar is certainly high.
Yeah. Gabriel, in that same conversation last year, you talked about seeking the same level of return, but via a slightly different path, given that rates had changed dramatically from where they were 10 years prior. With rates now rolling over again, do those return paths change once again in this new environment?
Yeah, I would say that, pre-2022, we were certainly investing in a very different environment. Rates have come down slightly, but, it's arguable as to how much more further they'll go down, right? I think it's going to be probably steady to maybe a gradual couple more cuts back end of this year. But regardless of that, I think our fundamental approach has always been about operating performance, right? So I think we're still, as you said, targeting the same level of returns as we were, right? But how we get there is slightly different, right? So there's a lot more emphasis now on skill-based levers, right? For example, being able to grow top line, right? Being able to maximize EBITDA margins, to maximize profit, right? And there's another dynamic around accretive M&A, right? For some of the co-investments that we invest into or some of these GP-led continuation funds, right? It revolves around a platform asset that has the opportunity to go out there and pursue, accretive tuck-in M&A. So that has been another, important lever of value creation. So I would say that there's less dependence now on financial leverage, right? If rates do come down, that's probably, an upside for us. And, in terms of multiple expansion, we always, assume the same multiples, buying in and exiting, right? Sometimes, we are a bit more conservative, assuming, a multiple contraction and the returns need to stack up in those cases. So yeah, in summary, still underwriting to the same returns, but more focus on skill-based levers rather than market-based levers.
Yeah. Gabriel, the firm strategy last time we spoke was leaning more towards resilient and defensive sectors, so education, healthcare, software, business services. That mix was a product of both the bottom-up and the top-down approach that you apply. Again, has it changed since we last spoke, and if so, why?
Yeah, no, I think we continue to like those sectors, for its resilient characteristics and defensive nature, right? So I would say that the bulk of the deal flow that have come through in the last year or so have been focused around these sectors that you mentioned, right? But I think additionally, besides liking the sector, which we need, to see strong secular tailwinds, I think an asset-based view is also super important, right? Bottoms up underwriting, it has to be a market leader with mission critical products or services that it provides, strong moats, and strong financial profile, right? And then the other sort of I would say critical factor for our investment making decisions is really the GPs that we partner with, right? So we'll need to have conviction that the GP has a good track record in the space, in the sector, and the ability to drive, the operating levers that we just talked about, top line growth, market expansion, creative M&A, and importantly, position the asset for an exit.
Deal activity, you referenced it at the top. It has moderated since the peak in 2021, but you said Neuberger in particular is going okay. But just broadly, do you expect it to bounce back this year and moving forward?
Yeah, I think, from a market perspective, as you rightly mentioned, it's certainly moderated, right? But as we look at sort of the first 3 quarters of 2024 at least, right, I think we do see deal activity on the private equity side ticking up quarter on quarter. So there is some encouraging signs that, deal momentum could be positioned for a return this year, right? And there are a few factors that, I would say lend itself to some cautious optimism, right? I think rates have come down slightly, right? There is a more pro-business administration, right? And, just over time, buy and sell expectations have converged. And I think importantly, there's a large, number of assets that need to be sold, right? As we look through the statistics, about, half of the private equity portfolio companies have been held for more than 4 years. So there is a need to drive those exit events. So we do see, M&A, private equity volumes coming back, right? But, in spite of the market moderation, at least from our perspective at Neuberger, I think deal flow has been, stronger than ever, right? A function, as I mentioned, of our relationships and network, and also us being proactive, right, in creating some of these situations for ourselves.
Fantastic. Gabriel, thanks for sitting down with Livewire.
Thanks for having me.
If you enjoyed that video as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.